Hello, this is Dr. Phil Rosenkrantz from the Industrial and Manufacturing Engineering Department at Cal Poly Pomona. Welcome to EGR 403 Online, Overview of Accounting Part 1. At this time, please move to Slide 2 of the presentation. This is the big picture for EGR 403, and I intend to show this at the beginning of each presentation in order to demonstrate where we are within the course material and put some kind of a setting in place. We're at the very beginning where we're going to be talking during the first 4 parts of EGR 403 Online about accounting and break-even analysis. This will be the framework that we'll use to build the course outline. Please move to Slide 3. I believe it's important for engineers to understand accounting and understand the language of accounting, because middle and upper management use this language and use the concepts, and so it's important for engineers to understand this so they can understand how the information that they produce is going to be used. And when making presentations to middle and upper management, this can be very important. Also, performance evaluations of engineers are often based on accounting data. Budgets are based on accounting data. Sometimes performance is evaluated based on how well you lived up to some budget. And I found that it's difficult to interpret some of this information or to find mistakes that are made if you don't have some accounting background so that you can follow the trail of how data was gathered and how it was used and how it was reported. Let me mention that when I finished my bachelor's degree in engineering, I went on and got a master's in industrial administration, and it included a lot of accounting classes. And I can't tell you how many times that information helped me out during my career and even helped me in advancement because I had that knowledge. Okay, please move to Slide 4. At Cal Poly Pomona, industrial and manufacturing engineers take accounting in IME 239. Most other engineers pick up accounting in an MBA program somewhere, so that's something to keep in mind. Engineering projects are undertaken in companies largely based on their ability to generate profit. And profit's an accounting term that we need to understand. The equation for profit, the just overall equation, is that profit equals revenue minus expenses. Let me discuss those terms a little bit. Terminology is real important in this course, and these are some of our first and very basic terms. Revenue is money in, money that the company generates by being in business. Sometimes you'll see the word income used here, or sales, depending on the way the company is reporting their profit. Then from revenue, we have to subtract our expenses, the money that we had to expend in order to make our product or provide our service, and these are our costs. So the profit equation is revenue minus expenses. Please go to Slide 5. Manufacturing is primarily involved with the expense side of the profit equation. Sales and marketing is primarily concerned with the generating of revenue. If we talk about manufacturing for a minute, there's many ways that we can control our costs. One is when we design the product and design the processes we're going to use, we can design those so that they are low cost to begin with. But even after that, once you're in production and manufacturing your product, you have many costs that need to be controlled for materials, for labor, for energy, for just many things. And engineers get involved with projects that will minimize those costs on a very large basis. And then once you are under control, there's always room for improvement. And so continuous improvement programs are vital. And many engineers are finding themselves involved with formal continuous improvement programs in companies. There are also intangible considerations when we're talking about whether or not to undertake a project. Those have to do with what resources we have or what capabilities we have or that we're trying to acquire. and there may be some strategy involved with why we may choose to do a project in terms of where we're going in the company. The intangible considerations can be very minor, or they can be large, but what we're going to concern ourselves mostly with in EGR 403 are the financial aspects of economic decision making. We won't completely depart from the intangible considerations, but when you're putting the information together to decide whether you're going to invest in something or pick project A over project B, one of the things that is going to be in the mix is the financial analysis. Please go to slide number 6. In the world of accounting and business, they use different reports, standard reports, to indicate what the financial situation is for a company or business. And financial statements that are very commonly used are the balance sheet, income statement, and cash flow statement. Later on in this presentation, I'm going to cover 2 of these statements, the balance sheet, which will be in part 1, and the income statement, which will be in presentation number 2. Please move to slide number 7. In the world of accounting, there are some basic concepts that are important. There's one concept that I want to cover right now because it'll help understand the financial statements, and that is the concept of matching. That is matching revenue with expenses so that profit represents the actual business and the actual expenses generated during the time period involved. And that can be illustrated by talking about 2 different methods. The cigar box method, which is basically just money goes into the cigar box and money goes out. We don't hear too much about cigar boxes anymore, but this term goes back to when there were cigar boxes around everywhere. And if you were a small business or just an individual, as money came in, it went into the cigar box or the wallet or the purse, and as expenses came up, money went out. And you just look in the cigar box or the wallet or the purse, and what you had left was your profit, and there was no real timing involved. Accrual accounting, on the other hand, refers to going through the trouble of matching expenses and revenues so that profit reflects the actual activity in a particular time period, let's say for a year. And this is real important for purposes of determining what taxes you owe and for getting a truer picture of what the performance is of a particular project or of a particular company. Okay, please move to slide 8. Talk for a minute about costs and this term called depreciation. Costs fall into 2 categories, expenses and capital expenditures. The word expenses can mean a lot of different things, but most of the time when it's used in management, the word refers to costs that have a use for items that have a useful life of less than 1 year. There are 2 types of expenses in this category, fixed and variable. Fixed costs refer to items that are the same throughout the year, no matter what your volume of activity is. For example, if you lease a building, whether you produce 1 part or 1,000 parts, the lease cost is the same. And insurance is another example. There might be certain insurance costs that are fixed. Some labor costs are fixed, like for executives or upper management or certain services. Variable expenses or variable costs vary with production. For example, direct labor, materials, supplies, and utilities. And those have a tendency, of course, to vary with how much you're producing. So if you don't produce anything, you're not going to hire any direct labor, you're not going to need any material. And the more you produce, the more of those that you're going to, more money you're going to spend in that category. And so variable expenses are related to the volume. Capital expenditures, the next category, refers to money spent on improvements or additions that have a useful life greater than 1 year, like machinery and buildings and furniture, vehicles and things like that. We have a lot of money spent on those kinds of things, and they could last anywhere from 2 years all the way up to, say, for a building, it could last 40 or 50 years, or up to a pipeline or a dam or a road or a sewer system that could last for 100 years or more. Depreciation refers to the allocation of those capital expenditures over some sort of a useful life so that we can match the revenue with the share of expenses from that capital expenditure. And let me just point out right now that land is not considered depreciable, so we don't do that with land. Okay, please move to slide number 8, and we'll talk about depreciation some more by using an example. I'm just trying to make sure that you understand it. Let's say, for example, you purchased a $50,000 computer numerical control machine, a CNC machine, that has a projected useful life of 5 years and a salvage value of 0. Now, the salvage value is what the equipment is worth at the end of the 5 years, either as used equipment or as scrap. And in this example, we're going to say that it's worth nothing. So you would just dispose of it. If we were to deduct the entire $50,000 as an expense the first year, we wouldn't really be matching the revenue with the expenses, since there's 4 years of life of the machine left. We didn't use the machine up in the first year. So we're going to use depreciation, and in this case, straight line depreciation, which we'll cover again in Chapter 10. And we're going to spread out the $50,000 over the 5 years. So $50,000 divided by 5 is $10,000 a year. So we will use as depreciation expense $10,000 a year, and we're going to do that for 5 years. And so hopefully you'll be able to see how we've just matched revenue with expenses here. Okay, please move to slide number 10. On slide number 10, we're going to talk about our first financial statement, the profit and loss statement. The profit and loss statement has a couple of nicknames or other names. One is the P&L. You might have heard that mentioned somewhere. Or the income statement. So if you hear any of those, you know they're all talking about the same thing. This is the financial statement where it shows what the profit is of the company. The first part of the P&L talks about the total amount of income or total revenue, and in this example it's $100,000. And then we list our expenses, and I'm using the 3 categories I mentioned before. Fixed costs, in this case $25,000. Costs of goods sold, which is very common language when you're talking about a product, and those are your variable expenses. That's how much you spent on the materials and the labor and the overhead to produce the goods that were sold. So let's say that's $50,000, and then our depreciation expense of $10,000, and so our total expenses add up to $85,000. That gives us a gross profit of $15,000. And now we have to decide what's going to happen to this $15,000. Well, out of this gross profit, we have to pay some taxes. State and federal taxes, for this example, I'm going to say 40% as a combined state and federal tax rate. For a large company, it's going to be larger than that, probably closer to 45%. But anyway, if we use 40%, our state and federal taxes will be $6,000. So our net profit, or the bottom line, is $9,000. Okay, now let's go to slide number 11, and let's talk about what happens to that $9,000. Out of that $9,000, one of the things we'll probably have to pay are dividends. And dividends are money paid to the shareholders in return for their investing in the business. And this is because they've put their money at risk. These are the people that put the money into the business so that it could start, or they own part of the business because they've purchased some shares of stock. And so they're entitled to some return. After all, they would like to make some money off of their money. In our example here with $9,000, let's suppose that 1/3 of that net profit is declared as dividends, and so $3,000 is paid to the shareholders. That would leave $6,000 retained in the business. At this point, let's talk about those dividends for a second. What happens to those dividends when received by the shareholders? Well, those dividends are income for shareholders and therefore are taxed again. And this is the concept of double taxation that sometimes you hear about on the news, or sometimes politicians will talk about it. And that refers to the fact that corporation profits are typically taxed twice. Once as a corporation, and then the dividends are taxed as personal income. And so a majority of corporate profits actually do go to taxes by the time you add those two together. Some companies declare very small dividends because they need their profit to be plowed back into the company for growth. Other companies pay very high dividends because a lot of people that have invested in those stocks are expecting dividends so that they can live off them. So we have $6,000 remaining of net profit. And this gets us back to the title of the course. The title of EGR 403 is Capital Allocation Theory. And we're talking here about taking this money or this capital that we've made as profit, and how are we going to spend it? What are we going to allocate it to? And let's discuss that for a minute, because this is a very important issue. What a company values, what they consider to be important to the company, to the people that work in the company, to their customers, is going to guide them on how they spend their money. If you're trying to grow, if you're trying to stay modern, if you're trying to stay competitive, then you're going to certainly want to invest some of this profit back into the business in terms of new facilities or new equipment, or in maintaining them well and making sure that you have the right equipment in place to generate your revenue. And so this is called retained earnings, and because you're retaining those earnings in the business. You can, if you want, take some of this capital and you can pay off some of your debt. And that's healthy sometimes, because now you won't have to be paying interest on those loans or dividends on bonds that you might have. Another thing that you might do is take some of that money and put it into profit sharing or bonuses or indirect benefits for employees. Well, that's a good thing, because if you can keep your employees happy, if you can retain your best employees, then they can help you make even more profit. So you don't want to kill the goose that laid the golden egg. You may need to or want to plow some of this money into research and development, because you want to stay competitive. And in some industries, research and development is your lifeblood. That's what's going to keep your sales up. You can plow the money back into permanent raises and or increased benefits to employees. The problem with that is that as you give permanent raises, they continue to be expenses for the company, whether people produce or not. I'm only pointing that out because there's a trend in many of the top companies now to have competitive salaries and competitive base salaries, but to put more emphasis on bonuses that are based on performance of teams and work groups and divisions, and plow that money into profit sharing. Finally, if your company values its relationship with the community, with community relations, and with making sure that there's a healthy labor market, you might want to put some money into education, into scholarships, into supporting local schools, helping the community various ways. And finally, the last item I want to talk about with respect to net profit is sometimes companies will buy back some of the stock that is out there on the stock market so that it's owned by the company. And the reason for doing that might be either for just investing the money, but another reason is to avoid the possibility of somebody buying up that stock and taking over the company. So some companies, when they have the chance, will buy back some of their own stock. And by the way, they can sell that stock off later if they need some cash. Okay, going to slide 13, the bottom line in the company is profits. And when you hear that slang term, the bottom line, what they're talking about is the last line on the profit and loss statement. That is, what is the profit? Now, traditionally, in the older days of accounting, where things were done with ink and in ledgers and on paper, black ink was used to represent a profit. And so if a company was profitable, the slang term used was that the company was in the black. Also in those accounting days, losses were shown with red ink. And so sometimes the slang term for a company that had lost money was that they were in the red. So anyway, just a little bit of terminology, and this ends our first presentation. And so in the next one, accounting part 2, we will talk about the balance sheet. Thank you.